Today is Friday, February 26th, 2021, and I'm your host, Max Gottlich, and I talk about my interpretations and insights into financial markets and the global macro economy. Well, this past week, the elephant in the room certainly goes to volatility throughout financial markets. The House is set to vote on Biden's $1.9 trillion stimulus. Obviously, we've talked about the Treasury curve steepening with the 10-year climbing all the way to 160 or so basis points. And today, we actually saw a retracement higher for bonds, right? We saw TLT closed just above plus 3% on the day. And so it makes a lot of sense, given the dovish environment or dovish Fed, that the earnings yield on the S&P is at the lowest point against the 10-year in 10 years. So clearly the bond market is telling us that stocks are extremely vulnerable, right? They're extremely vulnerable with the 10-year literally between 125, 150 basis points, which is historically extremely low, right? Which shows how levered everything truly is. But we're not just seeing asset price inflation, but we're seeing input costs for manufacturers. They're extremely high right now. And we're seeing supply constraints appear left and right, which makes prices go higher, obviously. We also got fresh data from the Fed for new orders for US manufacturers, durable goods, and that was up 3.4% in January, just under 7% year growth, and the increase, annual growth, and the increase was primarily led by transportation. And this is actually the ninth consecutive increase, in which orders, in new orders, which pretty much parallels to the vaccine getting distributed more and, COVID deaths and cases declining pretty rapidly. And we also, of course, got the 4.1%, increase. We got the Q4 number in real GDP. And of course, you also got the speculators piling their cash into quite literally everything except gold, except bonds, and except the dollar, right? Based on my macro thesis, I believe gold is the biggest lag of them all, frankly. Even hedge funds have reduced their net long exposure to gold futures. But when the Fed owns 21% of all issues outstanding and the dollar is trading 15 or so percent below its August highs, it's kind of hard to believe that the gold bears, will sustain their superiority in price action. It's also pretty hard to see gold not go higher because inflation expectations are hitting multi-year highs, money aggregates and twin deficits, and the Fed's balance sheet. They're all at record levels. So you see, it all comes down to the Fed. They are the ones that enabled an artificially low interest rate environment, and that resulted in easy money to this day. It gets easier and easier, which resulted in, it encouraged people to not save and invest, but to rather consume and spend, which is obviously the opposite of a productive, quote unquote, free market economy. But the irrational exuberance I want to get back to in the stock market, that's also a result of the Fed and easy money. In fact, I have here a quote from Robert Shiller, the Yale professor, Nobel laureate, who I look up to quite a lot in behavioral finance. But the quote is from one of his books called Irrational Exuberance. I believe it was from the year 2000. And the quote says, where a situation in which news of price increases spurs investor enthusiasm, which spreads by psychological contagion from person to person in the process of amplifying stories that might justify the price increases and bringing in a larger and larger class of investors who, despite doubts about real value of an investment, are drawn to it partly by envy of others' successes and partly through a gambler's excitement. End quote. And so this is Schiller's definition of irrational exuberance, right? What I just read to you, which in essence, it describes a psychological snowball effect and very much like what's happening in the price of Bitcoin, right? So, how does an investor buy and sell a security? Let's ask the obvious. Well, one of my personal favorite Warren Buffett quotes is to be fearful when others are greedy and greedy when others are fearful, right? Everybody knows that one. And I mean, it's a very simple contrarian concept and one that's been proven to work over a very long period of time. I mean, we know at the end of the day, the stock market is efficiently inefficient. That's another quote by Eugene Fama. And that means that all variables are essentially relative to each other. And in essence, a 5-star rated hedge fund manager has literally the same probable chance at realizing a dollar profit as would a brand new Robin hoodie realizing a dollar profit. There's no difference. Okay, well, this is all I wanted to get into for today's show. If you enjoyed, please hit the like button and comment and subscribe if you haven't already. Also, note I'm not a financial advisor, and everything I say is entirely for educational and informational purposes only. Okay, thank you, everyone, and have a great weekend.